Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. I also appreciate all the Cash Flow Club members on a daily basis that are in the community actively looking for stocks to value. Thank you very much. This week, we're going to take a look at Verizon, the wireless communications company, whose stock has been hammered recently because of their debt level and their forecast. Let's check out the stock and figure out how much money we can make if we bought the stock today and held it for 10 years. Ready? Let's get to work. All right, Verizon is a monster communication company. It's been growing revenue and earnings. Let's figure out how it stacks up against our 5 key attributes, all right? Number 1, top line revenue growth has to be growing. Number 2, EBITDA, enterprise level earnings. We need that to be growing. We need strong free cash flow, low debt, and well priced. What is a well priced stock? Well, a well priced stock is a stock with a conservative forecast that will beat the market. It's simple to say, it's hard to do. We want a stock with a very conservative forecast, conservative market multiples, but is projected to beat the market over a 10-year period of time. Let's take a look at Verizon and see how this stacks up. So behind me, I have Verizon's revenue. Revenue of $120 billion through $133 billion through fiscal 2021. Their fiscal year ends in December. We haven't come to December 2022 yet, so this is basically the end of last year. Looking forward, earnings are about flat, so we'll kind of keep that in mind as we go forward. But overall, this revenue is slowly growing, absolutely barely checking the box. Certainly in inflation terms nowadays, right? If inflation is running at 8%, and revenue is growing at 1.3% historically, then that's declining revenue in real terms. We really want to take a look at it and take that in consideration. EBITDA is our enterprise level earnings. That's earnings before interest, tax, depreciation, and amortization. That is what we're looking for. It's basically flat here. I did kind of average the last 3 years leading up to this interval and the 3 years following to give me 1.6%. But I think basically it's flat over the long period of time, certainly, again, given inflation. Let's take a look at 10 years of debt levels for Verizon, or 9 years. So their debt was $93.5 billion in 2013. That number has grown kind of steadily, actually faster, if I just add a zero here. So 8.4% versus 1.3%. Their debt is growing at 8.4% annually, while revenue and earnings are growing at 1.3%. So the debt levels keeping up with inflation, ironically enough. Earnings and revenue are not. That's kind of an issue for us. Let's see how it stacks up on a multiple basis. CapEx $141 billion to $215 billion. Actually a slight increase there, 5%. That's interesting. Enterprise value, right? Enterprise value, add the debt plus the common stock equity, add them together, less excess cash gives you enterprise value. That is the true value of a business. Forget market cap. Market cap is just what trades in the stock market, and it ignores all the debt that the business has on it. You always want to look at enterprise value. Here, basically combining these two, you got a 7% annualized growth rate, just shy of $400 billion. Now, it's a lot less than that now. The stock has come down, but I just want to show you historically, it's been two and a third to $400 billion. Next thing we want to take a look at some market multiple data. So this is saying, we'll take the debt level first. Net debt to EBITDA, this is me taking the $177.9 billion of debt, dividing by the free cash, or excuse me, subtracting free cash, which is 0. So you get the full amount of debt, divide by the earnings that they made, that get to tell me how many years of operating history do they need to pay off their debt. It's a great benchmark. Banks will typically lend 3 times EBITDA as a senior level lender. When you get beyond that 4 times, 5 times, you get into junior money or mezzanine financing. The interest rates go up. There's warrants. There's other covenants that allow the debt companies to control the business a bit better. And it's a greater risk to us as equity owners because we are always at the bottom end of the capital structure. We are the very last in line in bankruptcy court to get paid. So it's extremely important you're buying companies with low debt, especially ideally less than 3 times debt, but ideally 0. So Verizon has $3.7 billion, 3.7 times debt to EBITDA as of the last fiscal year. Now, if earnings dip or they have to borrow more money, this is going to go north, and that's getting too high. It's above our 3 times metric. It used to be reasonable. But with debt growing faster than earnings, it slowly increased this multiple over time. That's a bad sign. Enterprise value to EBITDA. This is a kind of a payback ratio. How many years must the business run for it to generate the earnings to pay for itself? It's kind of a rough metric of payback period. And you can see it's roughly, that's the cheap end, 4.8, but it's been in this, I'll call it 7 to 8 range in the last 9 years, with a notable exception here really early on. But it's been seven times EBITDA. All right, let's take a look at free cash flow. Free cash flow, my favorite statement, your favorite statement, the cash flow statement. So free cash flow from operations, CFO, cash flow from operations, it's the first third of the cash flow statement. If you pull up a set of financials, you're always going to have the balance sheet first. That's always what is presented, the balance sheet, then the income statement, then the cash flow statement. The cash flow statement is the link between the balance sheet and the income statement. The cash flow statement bridges the two statements. That's how the three statements connect via the cash flow, and you can't hide it. That's why I like to focus on it. Cash flow from operation, $38 billion to $39 billion, basically flat for the last decade. Now that foots to our EBITDA number, which is basically flat for the decade. So not a great number, but at least it seems to be footing and accurate. So good job, accounting team. Thank you for that. So this is relatively flat, certainly in a inflationary environment. This is losing 8% in real terms. If inflation is 8%, right, you want real growth. So that's growth minus inflation. If inflation is 8% minus, if growth is 8%, if growth is 0 and inflation is 8%, then you're negative real growth. That's the way that works. CapEx, they can't afford the CapEx. So CapEx is them building out their infrastructure, their network. So they can afford this, which is nice. They're just not growing it, which is a concern. And debt levels mostly big positive here for some acquisitions that they've done, but you can see when they have to pay down debt, it does hit cash flow and impacts the cash money that comes through to us, the equity holders. So free cash flow is $41 billion last year, but they paid $22 billion they borrowed $22 billion for a large acquisition. Realistically, their cash flow was about $20 billion. Just the cash flow they generate from running their business, less the CapEx, is $20 billion. Shares outstanding have also been growing. Now, this is a concern of mine as well. If you've got growing debt levels and growing share count, they are simply unable to generate the cash that they need to fulfill all of their obligations. And they're pulling financial levers to keep this train running, right? So you've got 2.8 billion shares outstanding last decade, now 4.1. That's like a third increase over time. So that means if you bought the shares back then, even though you're getting a healthy dividend, there are more and more people joining the pool. They're cutting the pie in smaller and smaller pieces. So your pro rata share of ownership is falling. That's not what you want. Also, so then I take the free cash flow per share. This is free cash flow here divided by shares equals here. You can see when I get to free cash flow per share, let's just stick with this, is $10. But this includes the $20 billion of debt that they borrowed. If I zero that out, I'll just take the last 3 years, you're in this range here. So putting aside debt, they've got 4.3, 5.7, 4.6 dollars per share of free cash flow given their capital structure historically. You then have the price per share and a yield. Yield's currently very high, above double digits. All right, let's take a look at their forecast and figure out how much we think this business could be worth going forward. Hey, sorry to interrupt. If you like the content, please subscribe. I greatly appreciate it. Also, if you want more stock tips, check my website out, cashflowinvestingpro.com, where I produce one-pagers like this one summarizing 10 years of financial information for American Express. I give you a forecast of what I think it's going to do, and currently, I think it's yield 23% IRR for the next decade. An amazing stock pick. There's lots more. Check out the link below for a free one-pager at cashflowinvestingpro.com. All right, how do we forecast this business? I'm not going to try to get fancy here. I'm just going to say that they're going to continue to grow earnings on a very, very small basis, less than inflation, 1.5% over time. That gives me a $49 billion EBITDA target out 10 years. It looks like they'll probably be a little soft of that this year, but I think they'll be raising pricing, and you'll, over time, be able to defend this position for Verizon and grow EBITDA 1.5%. or $56 billion out 10 years from now. Now, I'll apply a 7 times market multiple to this business, and I get just shy of $400 billion of enterprise value. If I subtract off the debt, which could be about $200 billion, I get a market cap of $188 billion. Divided by the shares, I get a $45 price target out 10 years for Verizon. Now, free cash flow is the same way. If I take free cash flow, I used $4.94, basically averaging the last 3 years of cash flow less debt, or putting debt aside for a second, just looking at cash flow from operations minus CapEx for the average 3 years, I get this, and I run it out over time at the 1.5% at a 7% yield, and I get an $80.75 price target. All right, the next thing we want to do is we want to look at the stock market and see how much we can buy this share for. And right now you can buy as much shares as you want for $37 each share, down considerably since the last time we looked at it. We have a market value represented by free cash flow of $80 per share. We have an enterprise market multiple of $45 a share, giving you an average of $36 per share. Now, where the stock is trading currently, current enterprise value is $337 billion. It was as high, we're forecasting as high as $400 billion. Next year's EBITDA is just shy of $50 billion. That means it's a 6.7 times market multiple on a forward basis. If we look at what the market multiple was historically over the long term, you'll see in this range it's basically 7 to 8%. So you're currently trading at 6.7 on a forward basis. It's a little cheaper than it has been historically. It's also at a forward cash flow yield of 13%. Now, that is holding debt constant. I'm not paying down debt. I'm going with the fact that they're over three times in debt, and I'm not moving the interest rate on that money. This is just taking their historicals, going it forward, and seeing what it produces. So let's put this into an IRR forecast. Right now we've got cash flow per share. You're buying the stock at 37. You're out at 63, which was the average of those two investments. And over time, this produces a 21% IRR. If I bought it today at 37, I sell it in 10 years at 63, and I get this stream of cash flow that I own. Okay, now that's a very attractive return on for a stock. We need to now benchmark that or take a look at that forecast and give the old smell test, see how much we think we believe it. And the problem with this forecast that I see is the debt level. All these numbers are predicated on an environment of zero interest rates. All the debt that they have, that they've issued, and the interest that's flown through in the cash flow statement has been predicated on zero-bound interest rates. Well, interest rates have moved up rapidly. The Fed is targeting to beat inflation here in the United States. Typically, at least historically, moving the Fed funds rate above the inflation number is the best way and the fastest way to kill inflation. That would mean Fed funds at 8+%, which is monstrous. That means mortgage rates would be topping double digits. Haven't seen that since 1980. But nevertheless, that's where we're going. Fed funds is approaching 4% right now. So what we want to do is we want to take the free cash flow and we want to adjust it. And what I'm doing here, I'll show you this quickly. What I'm doing here is I'm saying, here's the cash flow forecast that I just gave you, assuming no change in interest rate, no change in the debt statement. This is me saying, okay, if I add 1.5% to the portfolio of debt immediately, and that's kind of a crude case because what's going to happen is A, their debt could be variable, in which case it would all rotate quickly. But most likely the debt here is mostly coupon bond debt, meaning the interest payment has been locked in. So the only time that debt is going to ratchet up in cost is when it has to be refinanced, because nobody pays down debt anymore, unfortunately. All they do is they roll debt. So over time, what's going to happen is their portfolio is going to change over time as chunks of debt come due. They're reissued with replacement bonds at a higher interest rate. So that's going to slowly ratchet up the debt. Their debt is pretty low historically, 2, 3, 4%. That's going to be reverted higher to 7, 8, 9% as it rolls over. So this is basically reflecting some sort of weighted average of that rollover to give you an impact on the $177 billion in the entire portfolio, even though it might take a decade for the entire portfolio to roll over. But if I increase it 1.5% on everything overnight like that, or 3%, how does it change the cash flows? And it changes them rather dramatically. You can see that if I use the same exit multiple, I go from $80 to $70 to $60. That is a 13% haircut or a 26% haircut to the price of the stock based on a free cash flow method. So let's go back. Let's go back and say we had an $80 price target. $80 price target, and I'm gonna put in a higher interest rate, 3% higher to hit the cash flow, right? Because the EBITDA, the enterprise value EBITDA, does not show the effect of leverage and debt because the EBITDA, the interest, is not included in that number of multiple, right? Because you're putting your own capital structure on it post-acquisition. That's technically why it happens. But the free cash flow method picks up the cash interest that you have to pay. And so what happened? Well, we just went from $80 to $60, and if I put that into my model here, I get a 15% return. So A, that's beating the market still. B, much lower than the 21% you just saw. So what does this look like then? If I put the $30 in here, and I put the $37 in this range, and I leave the higher interest rate, the 3% added to the $180 billion of debt. That means you're at a 15% market return. If the stock comes down, it becomes very attractive. If it goes up, it's obviously not. That's if you believe the interest rates will remain elevated for next decade or so, which they could. I mean, my personal belief is that we're going to have interest rates go up. The Fed is going to totally miss the target here. They're going to surpass interest rates. The economy is going to crater. Then they're going to have to cut interest rates again, just like they do it every single time they raise rates to kill the economy. They end up dropping rates again because they're like surprised that everyone goes ape-s and everything goes down. Then they have to cut rates to stimulate again. So it's a little bit of a roller coaster, but we're going through it. This is going to show you the impact of a little bit of inflation change. Personally, I think that this is, for me, I'm gonna go bad. Let's review the 5 key attributes. Number 1, top line revenue growth. Yes, technically it's growing. Number 2, EBITDA. Yes, it's growing. Number 3, strong free cash flow. Yes, cash flow's there. Number 4, low debt. No, it is not low debt. And number 5, well priced. No, I'm going to say it's not well priced. I just don't. So for me, technically, I guess it could be because it's forecast to beat the stock market, but I don't believe the forecast. I don't like the fact that they're not able to push pricing higher to defend themselves against inflation. I don't like that they have too much debt in the business, and I don't think the growth here is enough in the business to warrant the money being tied up in a company. The market is down. There are a lot of great deals out there, and check out the cash flow club, by the way. We're throwing stocks in there that are yielding 20, 30% IRR stocks on very safe, I don't say very safe, but companies with zero debt, large cash balances, great recurring revenue. There are companies out there that are crushing it despite the bad economy. Their stock price is down, absolutely, but there are gems of companies. Check out the Cash Flow Club, become a member, to try it for a year, see what you see. You're going to like a lot of stocks, and you're going to find those gems. You need 20 stocks in your portfolio that you own and you hold for decades, and those stocks could be 100 baggers for you. That's how wealth is made. It is not made by trading. Don't believe the hype that people say online. That is garbage. You're paying a lot of taxes. You're sitting at a desk. You're doing that work all the time. You're not making much money, and in any day you could lose a lot of money. Buy a company that you like, that makes cash, has low debt, has a great management team, and hold it for 20, 30 years. You'll pay no capital gains on all that growth. You'll get dividends, hopefully, and you have the best shot at truly making 100 times. If you've read that book, by the way, 1 to 100, that's what they do. They're looking at historical stocks over 20, 30, 40-year histories. And yeah, in that time, it goes up 100x. It's not overnight. You basically buy it and set it and forget it. You buy it and you put it away. That's the only way to own equities. Don't try to flip in and out of them. I want to plug quickly my course. If you want to learn how to do this and get this cash flow model and learn how to read 10Ks, learn how to calculate EBITDA, free cash flow, shares outstanding, correct for stock splits, reverse splits and splits. If you want to know how to forecast, what is a market multiple? What is a cash flow yield? How do you build a portfolio that's diversified? I have a course that teaches you how to act like a CFO, judge your own investment classifications, model your companies, build your forecasts, and have a portfolio that you can hold for a long, long time. Check out my website, cashflowinvestingpro.com, where I teach you how to be a financial analyst. It is a 3-hour course. It comes with 21 different lessons, a lot of examples, and I'm continuously building it out. It's a phenomenal course. It's been very highly rated. I definitely suggest you check it out and get the Cash Flow Club as well. Join the group. Find cash flow stocks. We are kicking out all kinds of one-pagers every week that give you lots of stocks, many of whom are yielding tremendous, tremendous cash. This has been Rational Investing. My name is Cameron Stewart. This is Verizon. Thank you for the day. Have a great time. Bye-bye.